Hi, my name is Rachel and I work in the Overseas Economies team at the Reserve Bank of Australia. This video is a brief summary of current economic conditions as published in our May Statement of Monetary Policy. The global economy is continuing to recover from the pandemic. Indeed, the outlook is for strong growth this year and next. This is because of progress on vaccinations and additional fiscal support in some economies. But the recovery has been and will continue to be uneven. You can see that in this chart. Each red dot shows how much the size of an economy, as measured by gross domestic product, or GDP, has changed from before the pandemic to now. Where the latest data is not yet available, the chart shows a forecast. Differences in control over the virus, vaccination progress, policy support, and exposure to the global goods trade have contributed to divergent outcomes and outlooks across economies. For example, strong external demand for goods continues to underpin the recovery in China and export-oriented East Asian economies with good control of the virus. Some of these economies have now more than made up earlier declines. On the other hand, ongoing restrictions on people's activities have weighed on economic growth in large parts of Europe, the UK, and Japan. Some of these economies still have a lot of ground to make up to recover from the virus. In Australia, the economic recovery is further progressed than in many other places. Timely indicators of economic activity suggest the economy recovered in the March quarter to be where it was before the pandemic started. In fact, the Australian economy is transitioning from recovering from the pandemic to expanding, earlier and with more momentum than anticipated. Favourable health outcomes, the removal of restrictions on activity, and extraordinary fiscal and monetary policy have supported this snapback in activity. That said, for some time, the size of the economy is expected to be smaller than what we thought it might have been before the pandemic. This is shown by the gap between the grey and blue lines on this chart, which is partly due to lower population growth than was expected before the pandemic. The forecast for GDP assumes the vaccine rollout here in Australia accelerates in the second half of the year, allowing the international border to be reopened gradually next year. It also assumes that no further large outbreaks and extended hard lockdowns occur within Australia. However, the nature and speed of the next phase of economic growth is characterised by some uncertainty, for example around household consumption and the extent of spare capacity in the economy. Household consumption has been an important element of the economic recovery so far. This chart shows the level of household consumption in blue and household income in purple. The data to the right of the line are forecasts. The blue line gives a sense of just how rapid and large the contraction in consumption at the start of the pandemic was, and also how rapidly consumption has recovered. Timely indicators suggest the level of consumption in the March quarter was only a little short of its pre-pandemic level, supported by the recovery in services, and will continue to grow this year, though at a more moderate pace. A significant boost to household disposable income from government transfers through the middle of 2020 has helped support this recovery in spending. Since then, household income has declined a little as some transfers were wound back, for example, reductions in the size of the coronavirus supplement paid to job seekers and others. But over the first half of 2021, household income is expected to be broadly unchanged, despite the expiry of policies like JobKeeper. This is because employment, which is the main source of income for the household sector, has recovered strongly. The decrease in consumption due to restrictions on what households could consume, alongside income support early in the pandemic, saw the household saving rate rise well above recent norms in Australia and in other advanced economies. This chart shows the savings ratio, that is, the share of disposable income that households save. So that we can compare across economies, the data are shown relative to an average over the years before the pandemic. Most economies' saving rates have declined from their peak in the June quarter last year, in large part because households' consumption opportunities have increased with the lifting of restrictions. This excludes the US, where household savings have surged again this year following further cash payments from the government to households. In Australia, the savings rate is expected to decline further over the coming year, as uncertainty about the pandemic recedes and opportunities to spend on consumption become more available. Some households may also opt to spend a portion of their savings accumulated over 2020 on consumption. However, this is a key uncertainty for the year ahead, and I'll talk more about how it affects some of the forecasts soon. The recovery in household consumption has also helped support conditions in the business sector. The top panel in this chart shows a survey measure that captures how positive businesses feel about conditions in the economy. The bottom panel shows how much of their capacity businesses report that they are using. When these measures are above zero, it means that businesses are feeling more positive or using more capacity than normal. If this is the case, they are more likely to hire workers and invest, which helps grow the economy. The blue lines on the chart show businesses that produce and sell goods, and the yellow lines show businesses that provide services. You can see that businesses in goods industries saw less of a drop in these measures early in the pandemic and a stronger recovery than services firms. Some of these businesses benefited from a substitution away from services when restrictions reduced the opportunity to consume them. In contrast, businesses in services industries were more affected by restrictions and only recovered later as they were lifted. With the easing of restrictions, consumption patterns have started to rebalance towards services. In the recent period, surveyed business conditions have increased a lot for both types of businesses, indicating that they are growing more confident in the strength of the recovery. This should continue to support investment in the near term, alongside strong growth in business profits and various government policies. A recovering business sector has also seen conditions in the labour market continue to improve. This chart shows the level of employment and total hours worked in the economy. The data to the right of the line are forecasts. Employment in particular has bounced back to be above its pre-pandemic level in March. This increase in employment has been faster than expected. It was helped by the ongoing easing of activity restrictions, which kick-started the recovery in services industries, where many people lost their jobs early in the pandemic. Strength in the labour market is expected to have offset any jobs that may have been negatively affected by the end of the JobKeeper program. Employment is expected to continue increasing, especially because we are seeing historically elevated levels of job ads and vacancies. The recovery in employment has seen the unemployment rate decline faster than was earlier expected, to be 5.6% in March. It still remains a little above its pre-COVID level because some of the increase in employment has been met by workers who were previously not searching for work. Under our baseline scenario, we expect unemployment will decline to around 4.5% by mid-2023. This tightening in the labour market should start to put some upward pressure on wages, which will support inflation. That said, recent inflation data have confirmed that consumer price pressures remain subdued in most parts of the Australian economy. And while the reversal of some COVID-19 related price reductions is expected to lift underlying inflation to around 1.5% in mid-2021, further out it's expected to rise only gradually, to be close to 2% by mid-2023. The statement also explores a plausible upside and downside scenario given uncertainties about the outlook. In particular, these scenarios focus on the effect of stronger or weaker than expected consumption on the economy. This hinges in part on how much households spend from their accumulated savings. The purple lines in this chart show what unemployment and inflation could look like in each of these scenarios, where economic conditions turn out better or worse than the baseline. In all these scenarios, though, wages growth is expected to remain below 3%. And as noted by Governor Lowe in a recent speech, for inflation to be sustainably within the bank's 2 to 3% target range, it is likely that wages growth will need to be sustainably above 3%. Based on evidence from both Australia and overseas, this will require a tight labour market for an extended period. In light of these developments and the outlook, at its May meeting, the Reserve Bank Board said that its current monetary policy settings will remain in place. The current policy package includes a record low level for the cash rate target, asset purchases, and long-term low-cost funding for the banking system. These measures are working collectively to deliver lower borrowing rates for households, businesses, and governments, contribute to a lower exchange rate than otherwise, and support the prices of some assets. All of this serves to free up cash flows, support the flow of credit, and provide confidence for households and businesses to consume and invest, which increases economic activity. For more detail on how these policies work, see our video explainers on monetary policy. The board has stated that it's committed to maintaining highly supportive monetary conditions to support a return to full employment in Australia and inflation consistent with the target. It will not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. For this to occur, the labour market will need to be tight enough to generate wages growth that is materially higher than it is currently. The board thinks that this is unlikely to be until 2024 at the earliest. At its July meeting, the board will consider some aspects of the policy package, including the possibility of future bond purchases once the current ones end in September. Thanks for watching this update. Links to more information are in the description, including our Statement of Monetary Policy, recent policy announcements, and education resources.